Good morning. Good morning, everyone. Please sit down. Okay. Topic for today's discussion is ratio analysis. Ratio analysis is one of the important tools used in the analysis of financial statements. Before we go ahead, let us understand the meaning of word ratio. Basically, ratio is an arithmetical relationship Okay. Basically, ratio is an arithmetical or numerical relationship between two numbers. As it is relationship between two numbers, one number is expressed in terms of another number. And there are three ways to express the ratio. That is, first way to express ratio is in terms of percentage. When we express or state ratio in percentage, we express it as like 20%, 25%, etc. Okay. Second way to express ratio is in terms of number. We can express one number in terms of another number as 2 times, 3 times, etc. And third way to express number is in terms of proportion. In this case, we express ratio as 2:1, 3:2, etc. like this. So basically, these are the three ways to express ratio or state ratio. After having understood the meaning of ratio and how it is expressed, let us move on the term ratio analysis. As we have discussed that ratio analysis is one of the important tools used in the analysis of financial statements. When we use ratio to analyze financial statement, we use the word accounting ratios or financial ratios. Okay, when we use the technique of ratio analysis in accounting, we use the word accounting ratios or financial. Basically, financial ratios or accounting ratios are relationship between two items of accounting ratio or financial ratio is relationship between two items of financial statement. Okay, you must be familiar with this word, that is financial statement. Financial statement includes trading account, profit and loss account, and third term is balance sheet. These are the main components of financial statement. So financial statement includes trading account, profit and loss account, and balance sheet. On the basis of their nature or characteristics, accounting ratios are classified into the various categories. Okay. But before understanding the concept of classification of ratio, first of all, we are going to learn or understand few important ratios, and then we will try to understand the concept of classification of ratio. Okay, so let us start with first ratio. First accounting ratio we are going to learn is gross profit ratio. Gross profit ratio is calculated as gross profit divided by net sales into 100. This is the formula to calculate the gross profit ratio. And this ratio is expressed as percentage. We express gross profit ratio in percentage. This gross profit ratio shows the profitability of the business or gross profitability of the business. So the importance of this ratio is that importance or significance of this ratio is that first it shows the profitability, of the business. First importance of gross profit ratio is that it shows the profitability of the business, and second importance that the ratio indicates the percentage of gross margin the ratio indicates the percentage of gross margin on sales. Okay, so this is the importance of gross profit ratio. Now let us see the another ratio, or second ratio, net profit ratio. Net profit ratio is computed by using the formula net profit upon sales into 100. Okay, so this ratio is calculated by using this formula, and this ratio is also expressed in percentage. Okay, this ratio is expressed in percentage. This ratio shows the overall profitability of the business. Okay, so importance of this ratio is that importance or significance of this ratio is that it shows the overall profitability. It shows the overall profitability of the business. Second importance of this ratio is that the ratio shows the percentage balance of profit, percentage balance of profit after meeting all expenses of business. The ratio shows the percentage of profit after meeting all expenses of the business. And third importance of this ratio is that the ratio indicates the efficiency of the business. Okay, so these are the points related to importance of net profit ratio. Net profit ratio shows the overall profitability of the business. The ratio shows the percentage balance of profit after meeting all expenses of business. And thirdly, the ratio indicates the efficiency of the business. So these are the points related to the importance. Now let us see the third ratio, that is operating ratio. Operating ratio is calculated by using this formula, that is cost of goods sold plus cost of goods sold plus operating expenses cost of goods sold plus operating expenses upon cost of goods sold plus operating expenses divided by net sales into 100. So operating ratio is calculated by using this formula, that is cost of goods sold plus operating expenses divided by net sales into 100. So here question arises how to calculate the amount of cost of goods sold. So cost of goods sold is calculated by subtracting the amount of gross profit from sales. So cost of goods sold is equal to sales minus gross profit. Okay, sales minus gross profit. Sales minus gross profit will give you the amount of cost of goods sold. And second word here is operating expenses. So operating expenses are those expenses which are related to the operating activities of the business. So operating expenses are those expenses which are related to the operating activities of the business. If we subtract the non-operating expenses from total expenses, we get the amount of operating expenses. Operating expenses basically includes administrative expenses, plus selling and distribution expenses. administrative expenses plus selling and distribution expenses. So this will give you the amount of operating expenses. If you understand which are the non-operating expenses, then it will be easy for you to distinguish between operating and non-operating expenses. So non-operating expenses are those expenses which are not related to the operating activities of the business. Those expenses which are not related to the day-to-day activities of business are considered as non-operating expenses. Examples of non-operating expenses are interest, which is a financial cost or financial expenses, or loss on sale of fixed assets, etc. These are the non-operating expenses. Okay. So if you want to calculate the amount of operating expenses, you have to add administrative expenses and selling and distribution expenses. Okay, this will give you the amount of operating expenses. So this is the formula to calculate the operating ratio, and you can calculate the amount of cost of goods sold by subtracting gross profit from sales, and you can calculate the amount of operating expenses by adding administrative expenses, selling and distribution expenses, and all those direct expenses which are related to the production or day-to-day activities of the business. Okay, operating ratio shows the total operating cost of the business as compared to the sales. If you see, cost of goods sold is this amount which is related to the purchase of raw material and direct expenses, and operating expenses are those expenses which are related to the operating activities of the business. Addition of these two, cost of goods sold plus operating expenses, will give you the total operating cost. So this is the total operating cost. Basically, cost of goods sold plus operating expenses is the total operating cost of the business. So importance of this ratio, that is operating ratio, is that importance or significance of this ratio is that it shows the total percentage of total operating cost to sales. This operating ratio shows the percentage of total operating cost to sales. Second importance of this ratio is that the ratio indicates the operating efficiency of the business. These are the two important points related to the operating ratio. High operating ratio means high operating cost, and which will result into the low profit. Okay, and similarly, low operating ratio means low operating cost, and which will result in higher profits. So this is one of the important ratios. Now let us see the next ratio, that's fourth ratio, which is stock turnover ratio. Okay, stock turnover ratio is calculated by using this formula, the cost of goods sold upon average inventory or stock. Cost of goods sold into average inventory. Cost of goods sold upon average inventory, and this ratio is expressed in times. It is expressed in times. This ratio is calculated by applying this formula and it is expressed in time. So cost of goods sold, we have seen how to calculate the cost of goods sold, and average inventory means inventory or average stock. Average inventory or average stock, we can say. The inventory means stock. It is calculated by using this formula: opening stock plus closing stock upon 2. This will give you the amount of average inventory. Opening stock plus closing stock upon 2 will give you the amount of average inventory or average stock. Stock turnover ratio basically shows that how many times stock is converted into the sales. Okay, so importance of this ratio is that importance or significance of this ratio is that the ratio shows the rate at which inventories means stock, inventories or stock which inventories or stock is converted into the sales. So this is very important ratio because this ratio indicates that at what rate inventories or stock is converted into the sales, and ultimately it can be converted into the cash. So sales means basically firm will convert the stock into cash. The second importance of this ratio is that the ratio indicates whether investment in stock or inventory is efficiently used or not. So this is the importance of this stock turnover ratio, which shows the rate at which inventories or stock is converted into the sales and ultimately into the cash, and the ratio indicates whether investment in stock is efficiently used or not.